Hello, this is Dr. Janice Cito, and I'm recording this screencast for my accounting class, and it's July 2015. We're doing Unit 1, Chapter 1, and the Chapter 1 is from their textbook, which is by Harrison and Horngreen. It's Accounting International Financial Reporting Standards. So we've been working on these review questions, and let's take a look at what we have. So the review question that we've been working on so far, let me just take a quick look. I'm just going to have to go down. Here we are. And it's the review questions that have to do with these short exercises. Let me just move this screen a bit. Let's see if I can do it. There it is. So some of these are fairly straightforward. 1 and 3. And actually 3. If you take a look at 3, here it is. It's about somebody who's come to you and asked, would you like to invest in my business? And remember, one of the things when you are investing in a company or a business is you want to look at the way it's structured or organized. Is it a sole proprietorship? Is it a partnership? Or is it a corporation? So if you look at A, it says, how do you limit your loss if they've invested in a business? Now, so it's one of either proprietor, partnership, or corporation. This one has to do with managing the business. And remember, we said if you're a sole proprietor, you can manage your business, you can do whatever you want because you're the only person in charge. Okay, and then this one, the third question is about giving creditors the maximum protection. So we could talk more about this in class, but that's where that. So there's one answer which is unique for every one of these. So if it's not sole proprietorship, it's partnership. If it's not partnership, it's corporation. Let's go to, let's see, where are we right now? Okay. Now these are the questions where you have to prepare a financial statement. Remember, anytime the business is doing activities, it generates revenue. And also, it creates expenses. So let's take a look at this one, number 10, preparing an income statement. Preparing an income statement is pretty easy. Let me see if I can find the... Basically, you want something like that, which we have. I put it on the website. I've also distributed copies for you. So you have to change the title because you're not doing a statement of changes of equity. What you're doing is you're doing an income statement. So let's take a look back here at, so when you're doing an income statement, what does an income statement look like? Let's go back, and here we are. An income statement. Here we are. Income statement has revenue minus expenses, which gives you net income. So you know that whatever information you've been provided, it's going to fall under one of these categories, revenue or expenses. Let's take a look at what the question says. The question says, Call Anywhere Wireless began with that much in assets and ended with that much in assets. They earned revenues of $94 million and had expenses of $23 million. They paid out dividends of $13 million. So prepare an income statement for the year ending December 31st, 2006 with the appropriate heading. So the appropriate heading has got to be Call Anywhere Wireless. Then you have what is that you're preparing, which is the income statement, and then the date or the time period for the year ending December 31st, 2006. What are the elements? Let's go back. The elements are revenue and expenses. Do we have revenue? Yes, we do. Where is that revenue? The revenue here is $94 million. What are the expenses? The expenses are $23 million. So the revenue minus the expenses gives you what they call the net income. So 94 minus 23 gives you net income of $71 million, and so you double underline it. So that's very easy. Now what people are probably thinking is, well, Miss Dr. Janice, what about the $13 million in dividends? And I was thinking, yeah, what about them? What about these assets? And I said, yeah, what about them? They give you lots of information. It's up to you to decide what's important. So this is the more bookkeeping side of it, like you're entering numbers. So an income statement only requires your revenues and your expenses. It doesn't require dividends and doesn't require total assets. So don't use it. All right. Now let's take a look at the next one. So this is the preparing statement of changes in equity for Rome Corporation. So they had retained earnings of 210 million, share capital of 100. The revenues were 380 with expenses 250. And they paid that much in dividends. So what you have to do is, what is the end balance of retained earnings? So we've been asked to prepare a statement of changes in equity. Remember, we've done something like that before in class. We've done 3 actually, September, October, and November. So let's take a look at what they tell you to do in the book, because this is a little bit more complicated than the very simple one we did in class. Okay, so here we are. Statement of changes in equity. So you know that statement of changes in equity have these categories. You have your beginning equity, then you have your total equity at the end. In between, you add, let's say share capital that's issued, and any net income. Then you subtract the dividends. So let's go and do that. What I'm going to do is I'm going to go and find, there it is. So let's use the template that they have on page 31, and this I put on the internet, so it's a Word document. So I'm going to make some changes. So Rome Corporation. Okay, so this document is called Statement of Changes in Equity, and the year ending December 31st, 2006. So what we have to put in is total equity for the beginning of the year. So January the 1st, 2006. We know that. And let's say we're going to add, so it's a share issuance and net income. Well, according to this, there's only net income. So okay, let's add net income. And then, let's see, let me just go back, take a look at what this has. Oh, okay, so it has net income. Then we know we have to do something here. So let's create space. Yes, let's create a space there. And then less dividends, and then total equity at the end of the year, which is December 31st, 2006. Okay. Now let's just put in some numbers. Now I really should get rid of one of these spaces, but well, we don't have time to do that. So 310, because it's in millions, and then 130. You add that together, and that's 400. 440. Now we're going to subtract the dividends, and the dividends were 43, and then the total equity is 397. I should double underline that. See if I can do that here. Double underline. Okay, well, it looks like I'm having trouble finding the double underline, but well, we know there is a double underline here. Okay, and so that is our calculation of the statement of changes in equity. Now let's take a look. Is there anything else that we can do before I run out of time in this? There we are. Let's go back. Prepare balance sheet. Oh, we know how to prepare balance sheets. So why don't you go and prepare a balance sheet. So we've got cash, receivables, and inventory. All these are assets. Company equipment, that's an asset. Now we've owed money, so this, we know it's a liability. And there's long-term liability, so this is that. And then share capital. Well, we know share capital is neither a liability nor an asset, so we know this goes under equity. So prepare a balance sheet with this information, and absolutely we can do that. All right, folks, I